I made a wager that the Federal Reserve will not raise interest rates in September. So let's see in today's video if I'm going to make money or lose money. Look, the next Federal Reserve meeting is on September 16th. And at that time, they're going to announce that they're either raising interest rates or they're not. So right now, there is no chance of them lowering interest rates. And I actually agree with that. You know, those odds like it's completely off the table. Okay, so on August 5th, I made a wager. I made a bet that the Federal Reserve will not raise interest rates at the upcoming September meeting. And when I made that wager, there was a 45% chance that I would win the wager. So I was actually the underdog in this bet. So I just want to emphasize that it was a relatively small amount for me. But I'm still hoping that I win the wager, because if they actually do raise interest rates, then I'm telling you, prepare for the stock market to go down pretty substantially. And as of today, August 24th, the odds of the Federal Reserve not raising interest rates has increased to 60%. So my wager is now favored to win. So I could always close my wager right now. I could take my profits, which is up about 40%, and just call it a day. But I want to reassess the situation. So let's begin. Now, first of all, why did the odds change by a meaningful amount? The odds that they're not going to raise interest rates in September went from 45% to 60%. And again, this is so important because if they do raise interest rates, it's going to be terrible for your retirement account, your stocks, your crypto, your precious metals, you name it, it's going to be bad. So here's what happened. On August 7th, the jobs report was released, and it showed that the labor market lost 23,000 jobs in July. And this is good for my wager. Listen, if the labor market is suffering and the Federal Reserve raises interest rates, then it's going to hurt the labor market even more. Okay? Why is that? Let me explain with a very straightforward example. Let's just say that I'm a business owner and I want to expand my business. And to do so, like, I don't got all that money, so I want to take out a small business loan. And of course, I'm going to be mindful of the interest rate. How much is it going to cost me to take out this loan in order to expand, right? Well, if the Federal Reserve raises interest rates, then what's going to happen to interest rates on small business loans? It's going to go up. And then it might be too costly for me to take out the loan. And if I don't take out the loan, I'm not going to expand, which means that I'm not going to hire more employees. So if the Federal Reserve raises interest rates, it's going to hurt the labor market even more. And then on top of that, here's something else that happened. On August 12th, the CPI inflation report was released, and the rate of inflation was not terribly high. It came in at 3.4% for July, and that was better than the 3.5% in June. Listen, if the rate of inflation was much higher, like it came in blazing hots, then the Federal Reserve would be much more motivated to raise interest rates to fight inflation, to bring inflation down. But 3.4%, I mean, of course, that's not good. But that's not like terrible back at like it was a few years ago when it was like 7, 8, 9%. Okay, so 3.4%. That's actually close to where they want to be. Like the Federal Reserve's targets, like they want to bring inflation down to a rate of 2.9%. That's their targets, and 3.4% for CPI headline inflation. That's not bad. That's not too far off. So essentially what I'm saying is that the rate of inflation, well, according to the governments, it wasn't blazing hot, so there's not that urgency to raise interest rates to bring down inflation. So that's why the probability that they're not going to raise interest rates went from 45% to 60%. And again, that's great for my wager. So it's the jobs report and the CPI inflation report that will sway the Federal Reserve's data-dependent decision. The September meeting is on the 16th. Okay, before that meeting date arrives, we're going to have one more jobs reports on Friday, September 4th, and one more CPI inflation reports on September 11th. And those two reports, they're going to change the odds in a very meaningful way. For better or worse, like we don't know yet. We'll see. Now, I want to share my reasons with you why the Federal Reserve, why they're not going to be inclined to raise interest rates at this upcoming meeting. And the first reason is like this, I'm just being practical and honest here, is that President Trump would be very upset. So listen, the chair of the Federal Reserve is Kevin Warsh, and Trump put him there. Basically, Trump gave him the job. Like, do you know how pissed President Trump would be if Warsh raised interest rates? Trump would probably start suing Warsh. Reason number 2 is that if the Federal Reserve raises interest rates, then the government needs to pay more interest on their newly issued T-bills, their treasury bills. And of course, that's not going to be good for the fiscal budget of the U.S. governments. It's going to piss off the governments. So reason 3 is if the Federal Reserve raises interest rates, that it would hurt the Japanese yen even more because the dollar would strengthen with higher interest rates. And this is not a minor issue. The Federal Reserve and the U.S. government, they've already intervened with a nice bailout package for Japan. And raising interest rates, that would be basically be a setback, even if it's a quarter point. And you have to remember that if we upset the Japanese, they're going to dump our treasuries, and they have 1.1 trillion of them. Now, reason number 4, if they raise interest rates, you're going to see a nasty drop in the stock market, crypto, precious metals. It's going to hurt the labor market as well. And doing that right before the midterm elections would be pretty devastating for the Republicans, the people that got washed the job. And reason number 5, the Social Security cost of living adjustment, the COLA, is based on the rate of inflation during Q3. That means July, August, and September. If the government reports a higher rate of inflation in August, then the cost of living adjustment is going to be higher for 70 million Social Security recipients in 2027. And that's going to cost much more money for the U.S. governments. And they are incentivized. So like, I'm just being honest here, they are incentivized to report a lower rate of inflation. Like, I have a hunch that inflation will be higher in Q4 conveniently, which is not going to affect the cost of living adjustment for next year. Now, I want to give you the opposing side, because if I have money on the line, I'm not going to turn a blind eye to the other side. So I want to give you the opposing viewpoint. So I took a look at the Federal Reserve minutes, and this is what they talked about their last meeting. And on page 9 of the minutes, here's what they said. Many participants assessed that raising interest rates would likely be necessary if inflation did not decline, but I want you to, so they're basically threatening to raise interest rates, but I want you to notice that they didn't say at which meeting that they would potentially raise interest rates. And I just want you to know that after the September meeting, the Federal Reserve will still have opportunities to raise interest rates at the October and or December meetings. Now, you have to think that if they had to raise interest rates, they would think that the December meeting would be ideal, given that that's going to be after the midterm elections. You know, just saying. And we cannot turn a blind eye to this one, because this is very important. At the Federal Reserve's last meeting, they did not raise interest rates, but 3 of the voting members wanted to raise interest rates back at that July meeting. The votes was 9-3. But in order for them to raise interest rates, they need a majority vote. So they need 7 of the 12 votes to vote in favor of raising interest rates. I'm predicting that those 3 back at the July meeting, they're probably going to vote again to raise interest rates. But the question is, can they get another 4 members to join them to get to the 7 necessary votes to raise interest rates? And here's another data point that I want to share with you. When the Federal Reserve looks at the labor market data, the most important data point to them is the rates of unemployment. The Federal Reserve is projecting that the rate of unemployment is going to end the year at 4.3%, and we are currently at 4.1%. So if you think about it, if the Federal Reserve raises interest rates, it's going to hurt the labor markets, right? But one way to interpret the situation is that the labor market is doing better than the projection, at least for now. Therefore, the Federal Reserve has wiggle room, right? Meaning that if they raise interest rates and they hurt the labor markets, then the rate of unemployment, let's just say, goes from 4.1% to 4.3%. Well, then in their eyes, it's going to be okay, because it's not going to be worse than their projections. And another thing that I don't like is that energy prices, oil, gasoline, are higher in August compared to July. So it's not by a significant amount, but it's still higher month over month. And that could contribute to a rising inflation rate in August, but of course August is not over yet. And when looking at July to August in 2025, so last year, energy prices were flat. So I'm bringing up 2025, because the rate of inflation, what they're going to do is they're going to compare August to 2026 to August to 2025. So this is something that, the rising energy prices month over month, this is something that I'm not liking. Okay, here's the way I see the situation. I made the wager that the Federal Reserve will not raise interest rates in September, and currently the wager's up by about 40. I'm at a 40% gain. Now on September 4th, the jobs report comes out. If that jobs report is terrible, if it's bad, or if it's awful, then my wage is going to be at an even higher gain, because again, if the labor market is suffering, then the Federal Reserve is less likely to raise interest rates and hurt the labor market even more. Now, in that event, if the labor market is suffering, the jobs report comes out bad. And let's just say that I'm at a gain of 40% right now, that it might shoot up to a gain of 60%, 70%. And then at that time, I may choose to just close the wager, just cash in and call it a day. Or I may, risk it for the biscuits. So we'll see. I'll have to reassess at the time. And listen, I want to invite you to join my investing community. You could join for free. We're increasing the amount of data, information that we're giving to free members. And I'm not going to lie, we're doing pretty awesome over there. So thank you so much. Link is down below. Please subscribe. And I wish you a very nice day. Take care.